Good morning, everybody. It is actually Tuesday, January 21st, 2025. Yesterday was a holiday. Markets were closed. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer, Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. If I have something to say intra-week, it will be published on LinkedIn. Please follow me there, Herb Morgan, or on X at Herb W. Morgan. The presentation you're seeing and are hearing has been prepared by Cantor Fitzgerald Investment Advisors. We are an SEC registered investment advisor, and this presentation is meant to be used by both investors and financial advisors, but they're all expected to make their own investment decisions. Nothing in this presentation is investment advice, tax advice, recommendation for the purchase or sale of any securities. It's all for informational purposes. The views expressed here are mine and mine alone, may differ from the views of CFIA's parent affiliates or other portfolio managers at the firm. We're off to a great start of the year. We had a 2023 fantastic returns for equities, followed in 24 with fantastic returns on equities. Start to get nervous about what might happen. It's rare to get 3 big years in a row. But we're starting off with a bang. Small cap stocks up 4.4%, mid cap right there, large cap doing just fine. International markets, everything did great last week and are all up on a year-to-date basis except emerging markets, which are basically flat. We had a big scare as the 10-year yield approached 5% a couple of weeks ago. That is now backed off or now down in the 460 range. So we had positive returns across the board in the bond markets last week as well. Let's get into the economic data, and then I'll follow it up towards the end with a couple of what I think are relevant slides for where we stand today. Let's start with small business optimism. It rose from 101.7 to a 6-year high of 105.1 in the prior month. If you remember, was the largest monthly increase on record. This came on the backs of an election, the election of the new president and the Congress, widely seen as less regulatory in nature, more pro-business, pro-growth, pro-jobs. So that set up the optimism and the enthusiasm. 7 of the 10 components within the survey rose. Sales expectations, plans to expand, i.e. CapEx, a major component to the GDP formula, C plus I plus G plus X plus minus M. The I, investment, capital investment, plans to expand investment rose. That's good. Inflation and labor quality, though, remain very serious concerns. We then got 2 inflation readings last week, one on producer prices, one on consumer prices. I think in the aggregate, the markets and the financial media saw those as positive. I would be less optimistic. And I'm going to explain why. We had, obviously the market reacted and interest rates came down, so that looks good. But let's take a look at PPI. It rose 0.2, so it was less than expected. That was the positive thing. That's great. Up 3.3 year over year, positive, better than the 3.5 expectations. But if you look at this PPI trend for, almost 2 years now, it's been trending higher, as has the core PPI been trending higher. But because it was better than expected just for the month of December, I guess it really shouldn't be better than expected. We should say better than feared. I wouldn't put this in the category of, hey, things are great, it's okay, inflation is whipped. The following day, we got the CPI, or the Consumer Price Index, probably most important to all of us. It was up 0.4, right in line with expectations. The year over year, 2.9, again, right in line with expectations. Okay, fine. Core CPI up 0.2 and 3.2 year over year. But the goal is 2. And the best you can say here is that the downward trend in core CPI is still intact. The CPI, the non-core, the headline, kind of looks like it's flatlined. Again, we're coming up on 2 years since we had the, hey, inflation is transitory, this is coming down. And it's hard to make the argument here that we're continuing to make any progress, though the market did interpret it differently than I am for you. We then heard from 2 regional manufacturing surveys. And remember, I said over and over, 85% of the economy is the service sector. Service sector is booming. 15% is manufacturing. It's been sanguine at best. Empire State or New York State survey fell to minus 12.6, was expected to be up. But it's also a very volatile series. okay, employment got a little better and the outlook improved a little bit. Then we follow that up the next day with Philly Fed survey, and this is, look at that reading. That's a crazy reading. Went from minus 10.9 to 44.3, and the estimate was for negative. So something happened in manufacturing in the Philadelphia region. New orders spiked. We don't know if that was one-off, big company, big ticket item. Shipments spiked, employment rose, and the outlook significantly improved. So great, we'll take it. We want it. We'd like to see it. But if you're worried about inflation, one of the things that kind of holding inflation back is a little softness in the manufacturing sector. And if the economy, if aggregate demand in the economy is picking up, the likelihood of more Fed rate cuts, which is what the market's depending on for its excessive valuation, it seems less likely than not that the rate cuts are coming. And that even began to spark conversation on the street last week about the potential for a rate hike. I wouldn't put it as high likelihood at this point, but it's on the table for some time this year. Another great thing we heard was that jobless claims remain very, very low, 217,000 for the week. Continuing claims also remain very low. If jobs are plentiful, we know that from the JOLTS report, layoffs are low. That's all good news. It means the consumer is strong. It means aggregate demand is strong. In a pure Keynesian model, that's not disinflationary, right? That is just not disinflationary. Follow that up with a great number for retail sales up 0.4%. Back out autos and gas, still up 0.3%. You can see, if you look here, you get some negatives on retail sales from time to time. And we just really haven't had much at all for the better part of a year and a half in retail sales. Business inventories up 0.1%. That's fine. Nothing really to see there. Housing market sentiment improved from completely awful to a little less completely awful. 50 is the line of delineation here between, hey, we're optimistic, something's going to happen and things are going to get better. And below 50 is things are just not good as far as the nation's home builders are concerned. Obviously, when the Fed started cutting interest rates back in September, sentiment started to improve. But the problem is the Fed only controls that federal funds rate. And really not much else unless they're intervening in the market, and they're not doing that right now. So inflation expectations are really setting interest rates, and these interest rates set mortgage rates, and mortgage rates are going up, not down, and that is cramping buyers, and that is cramping the sentiment of the people that build homes, the people that are in the industry of building homes. Housing starts, though, did surge. Surprise, it was a big spike after falling 3.7% in November. Single family was up 3%. Multifamily jumped the most, up 61%. So big news there, perhaps some more supply coming online. Industrial production up 0.9. Capacity utilization went up to 77.6. I watch capacity utilization, one of the few that do, I think, but as it's coming down, I often see it as disinflationary. It's a good sort of, not real time, but close to real time indicator there. And now you see it spiking back up. When you get above 50, you really start worrying about inflation. You can see we got right there. And that's when the inflation really came in, started to ease, and that's just not continuing to go down at all. We don't really want it to go down. So, I know we have pro-growth policy coming. I know we have, less regulatory policy coming. I know we have extensions of the very positive pro-growth, pro-portfolio components of the Tax Cut and Jobs Act of 2017, but our markets are also very expensive. And this chart here compliments of some of my Cantor Fitzgerald colleagues over in Ireland, which they used in a presentation this week and let me borrow. You can see here our forward PE ratio, right, is quite high, much higher than Europe, much higher than the rest of the world. So the argument would go, well, Herb, why aren't you just cutting weightings to U.S. equities and buying more of the rest of the world? Well, the answer lies, in this growth relative to the PE. So yes, we're high, and the red diamond represents sort of historic average. We're higher than average. The world is higher than average. Europe's kind of right in line with their average. But what we have here is, I always look at growth and price relative to growth. The price to growth, PE to growth ratio is much lower in the US. The bottom line is US is more expensive because it's where the earnings are. In terms of the innovative companies, the companies that are accruing the profitability related to the expansion of tech and artificial intelligence and 5G and quantum computing and all of these different things, these are for the most part US companies. So they're commanding that higher valuation, but they're also commanding higher earnings growth rates. So I don't think it's time, especially given all the positive pro-growth policy we have coming up, to underweight US or to go more into European companies just because of valuation. Things are cheaper for a reason outside of the United States. And I also think, and you've heard me say, and I'm not backing off this yet, even though we had a great week last week, I still think a correction is very much possible in the first half of the year. And I think we've got certain elements of wind at our back, and we've got certain elements of wind in our face, and one big one that is uncertain. Let's start with the things that are working for us, for our portfolios, for profitability to us as investors. Number one, I think the deregulatory nature of the executive actions that have happened and will continue to happen is definitely pro-business, pro-cost control, pro-profitability, pro-jobs, and pro-portfolio. This also translates into, hey, we already have a strong consumer. We have jobs aplenty. We don't have layoffs. All of this is great. The service sector is absolutely booming. The uncertainty around the Tax Cut and Jobs Act of 2017 provisions that are set to expire at the end of 2025, that uncertainty has gone away. We know that the Congress will either extend or modify or improve. And earnings growth we're in earnings season right now. Next week, we'll give you a chart, but it's fantastic. Only a couple of companies have missed. The vast majority of companies are doing better. So this is wind at the back. Wind in our face. We really don't know the implementation of trade policy or its impact on inflationary pressures, right? If we have across the board 25% tariffs on just Mexico and Canada, Deutsche came out over the weekend with a paper suggesting it would add a full 1% to the CPI. So we'd now be getting closer to 4% inflation. And the inflation we already have, forgetting about trade policy implementation, is already sticky. I pointed that out in the CPI and PPI reports. And if inflation stays high, then interest rates go higher. If interest rates go higher, stock valuations go lower. And then we get into this Doge, right? I'm so for it, right? I'm so for driving efficiency in government spending and delivering more and better and faster services to the citizens of our country at a lower cost. If Doge can do that and does do that, I think it's great. But it's because there's uncertainty around it now, I think their ability to implement is still yet unknown. And I'm going to put that as, Doge, I can put it over here on this side. But for now, it's going to stay on this side because we just don't know anything. And then straddling the middle is Fed policy. Right now, the futures markets are predicting a 25 basis point cut, but not until June or July. If that happens, then we don't getting all these cuts, then maybe valuations are a little high on the stock market. On the other hand, there's even a potential that if inflation remains too high, the Fed could raise interest rates this year. That would hurt the equity market valuations. So good things, bad things, and I still think the correction in the first half of this year is more likely than not. And now I want to expand a little bit on this Doge. Here's what I was able to come up with. Article 1, Section 9, Clause 7, right? No money this is constitutional stuff, right? No money shall be drawn from the Treasury, but in consequence of appropriations made by law. That is only the Congress. So the Congress, we know, is the power of the purse. The Congress appropriate funds, and the executive branch is required to spend the funds as directed. So could Congress come back in and reconsider budgets they've already passed and reduce those expenditures? Yeah, I suppose so. But we've also got, and I don't think it's likely, right? We don't think it's likely. Now we've got key laws here. The Impoundment Control Act of 74, which limits the president's ability to delay or withhold spending. So they can't just say we're not going to spend the money. If the Congress has appropriated it, Congress under this law has to do it. There's the Anti-Deficiency Act, which prohibits federal agencies as well as the presidency from spending more. We know that. And then the Budget and Accounting Act of 1921 establishes the framework for federal budget process and mandates agencies have to spend the money. And we've gotten in a situation where everybody wants to spend their money so that they can get more for the next year, and they certainly can't save money. They literally, legally can't try to save money and drive efficiency and deliver better services at lower cost. So I expect these laws to be challenged in the courts and maybe hopefully in the Congress. And therefore that creates an element of uncertainty that would contribute to my prediction for a first half equity market correction. I'm glad we're here. I'm glad we're talking about it. I'm glad there's a possibility that we can get something done, but I want to be ready to react to a market correction when and if it happens. Economic data this week, nothing yesterday. We had the holiday. Tuesday, nothing today. Wednesday, nothing. Thursday, weekly jobless claims, great. And then we've got the manufacturing services PMIs from S&P Global. Look at the expectation here, 49.9. This could cause the market to rally if this comes in over 50, because we haven't been above 50. I don't have the graph, but it's been many, many, many months since we've had expansion nationally in manufacturing. We've got consumer sentiment expected to be unchanged from December, and then existing home sales expected, relatively unchanged. Thanks for tuning in. As a reminder, give me a thumbs up, give me a like, follow me on LinkedIn, follow me on X. But the best place, YouTube, you get the full video, the charts, and the graphs. Thumbs up, like, comment, retweet, tell a friend, appreciate it. I'll be back to you again in 1 week.